In this video, I'm going to talk about a few additional features for long-term care insurance policies and kind of how that relates then to the selection of a long-term care insurance policy. So the benefit period for long-term care insurance policy, or kind of what governs benefits, can be done sort of a couple different ways. One could be it could cover a fixed period, basically. So maybe the person is insured for uh, the next 10 years or something like that. So it could be basically pays out over sort of a fixed period, or it could be sort of a fixed dollar amount. And so for the fixed dollar amount kind of situation, that would be basically the policy has a maximum amount that it's going to pay out, and once that's been exhausted, then the policy is done, right? Now, sort of as an example of sort of the fixed period, there have been at least some policies that are lifetime policies that sort of last forever. It's perhaps a bit more rare now, but that would be sort of the extreme case of the period approach to the benefits. Now, within the long-term care insurance policies, some can be considered tax-qualified long-term care contracts. And if it qualifies as a tax-qualified long-term care contract, basically it's treated like health insurance for tax purposes. And so the basic idea is either, depending upon the situation, if you're dealing with self-employment, you could essentially view it as a deduction. If you're just a regular individual, you might be able to deduct it as an itemized expense, possibly something like that for health costs. If you are receiving a benefit from your employer, as long as you meet certain criteria, of course, because in tax rules, there's always certain criteria, right? But if your employer is paying for it, then just like with health insurance, it doesn't count as essentially something you have to pay taxes on as a benefit. So, basically, if it's certain types of long-term care insurance policies, if they qualify as tax qualified, then basically they get the health care or health insurance kind of tax treatment. And now, typically, for long-term care insurance policies, what's going to trigger the policy is going to be like a triggering event, and you could have a couple different possibilities. One being some sort of chronic illness that has gotten to the point where the person is no longer able to take care of themselves and things like that. And that also kind of ties in with something called the activities of daily living. And if there are certain activities that are considered part of just day-to-day living, and if a person is unable to handle those activities of daily living by him or herself, then that can be sort of a triggering event, basically, where now the policy comes into force. Now, kind of thinking about some of these different features and things like that, what that leads to then is when a person is selecting a policy, they really kind of have to go through all those different kind of options and features and things that I've talked about so far in this video and in some of the prior videos to determine which policy makes the most sense for them. So from a selection standpoint, the most obvious thing is that the person who's trying to buy the coverage actually qualifies for coverage from a particular company. So if they're trying to select a policy, they have to make sure they actually qualify for a policy from that particular company. They're also going to be very concerned about the financial condition of the insurer. So review the financial condition of the insurer, make sure the insurer is in good financial shape and is expected to be around for a long time. Also, the person would need to review the benefit period. So how that relates, whether it's a fixed period of time, whether it's a fixed dollar amount, and whatever it is it deemed to be appropriate given the circumstances? So that's when with some of these kinds of factors, typically consulting with a financial planner would make a lot of sense to try to assess, does this actually make sense given the financial situation involved and so forth. The benefit amount, so how much it pays out. Again, is that going to be consistent with the person's financial situation? Is there an inflation adjustment? Is it, basically would that make sense? Are you comfortable with the inflation adjustment option that's available, that sort of thing? How long is the elimination period? Is that going to cause an undue financial burden? If the person has more financial resources, they can probably handle a longer elimination period. If they have very few financial resources, maybe they need a policy with a much shorter elimination period. Another factor that would be important for when selecting a policy would be what services are included or excluded, and sort of who's the gatekeeper associated with making some of these kinds of determinations. So, ascertaining who is that person going to be as it relates to this policy. And then also, how exactly are the benefit payments going to be made? And there are, three principal ways that benefit payments can be made. One being the expense incurred. So if there are actual expenses that are incurred, then the policy pays to cover those specifically. For the indemnity method, basically what happens in that scenario is if the person is dealing with a situation where they need long-term care, then basically it pays out like the daily rate, for instance, for every day that is the person is receiving the long-term care. So that's a little different from the expense incurred. The expense incurred is just, we got to tally up all the costs, and they're going to pay for that. The indemnity is more, okay, they're going to receive this amount per day for every day, or per month or whatever, for the benefits that are going to be received. And then the final one is the disability method. And in that case, basically, if a person is deemed to be disabled, they've met a qualifying circumstances for being considered disabled, at that point, then the policy is going to pay out from that point until either all benefits are exhausted or for the rest of the person's life, depending on whichever one comes first. So there's kind of a few different ways that those benefits could be paid out. And that would be something to review very carefully, make sure that you know what that method is and that it is suitable given the broader financial situation before a policy is purchased. Hopefully this video has been helpful. Thank you so much for watching and have a great day.